Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we have our FSC show, and we're going to talk about the Primary Vision Frac Spread Count. We also want to look at what is happening in Taiwan and around that area, and then round out with some of the data that's come out recently, or conflicting data, if you will, on some of the things from the U.S. economic front. And one thing that we want to talk about on the U.S. economic side, for those that watch the Econ show, we cover a lot of data sets. And as someone who has done this since 2006, I can tell you that sometimes they can bifurcate. And the question is, which one is the right, which one is wrong? And how was one leading, one lagging? And those are things that we want to look at, especially when we discuss the jobs report that just came out. So and now we pivot back towards the energy world of the Primary Vision Frac Spread Count, which fell by 6. So we went from 295 to 289, and it's worth repeating when you look at August. August is a weird mix of activity because you normally have a little bit of a slowdown in the first week of August that could extend into the second week, and then you get a pickup as we come into the back end of August, and then that accelerates through September to maintain that level of activity into October until we see a little bit of a decline in November. And then that accelerates obviously into December. But it's interesting because when you look at what the underlying data is, and if you want the granular piece, we offer that as a subscription. It's important to appreciate where this activity is. So we had a little bit of a dip in the Permian, some dips in some other areas, but the Williston's picking back up, and we continue to see activity ramping in some other key areas. But it's when you look at the number in general, it's again proving the point that we discussed back in July of last year, that we're running tight on equipment. It's not like there's all this spare equipment running around. There is some out there, which is why we're able to stay at this level, but we're fairly capped. And we've talked about 325 spreads out there. Maybe 310, 315 can actually work, but it's all a matter of where. This isn't something where if you want to drill in the Permian, you call someone up and they'll be there, in the hour. It's like, okay, we'll get in line. I'll call you back in 6 months. So it's all a matter of where is the activity happening, which is why we've talked more about some pickup on the other areas, because the main thoroughfare of production, or the areas that would have production, already have a significant amount of the equipment spoken for, and it doesn't make sense right now to see a bigger shift maybe going from one basin to another, just because it's costly and it's something that may make sense in the longer term, but in the near term doesn't, as the Permian is essentially maxed out at this point. And we'll have a report showing the total supply, which we do by basin, by company, by pumper, because we really want to know how much horsepower is not only just being marketed, but actually available. And I think that's the key crux of what is that difference, which we have in a report. So now when we start turning to the DUC side, or the drilled but uncompleted wells, one of the things we've been talking about is that we're going to have that addition. We had the rate of change slowing down. We actually had some increases in some key areas, and that's going to continue to be the case, especially when you look at where there's the shift. So when you look at land, the U.S. had a drop of 3. We had a drop of 7 oil rigs, but an increase of 4 gas. But the key component that we always look at is horizontal. Horizontal actually went up by 1. Now, when you look at the backdrop of the different states, really New Mexico was the largest decline of 6, but Texas still added rigs. And that's what we continue to see, is Texas, Louisiana, Oklahoma are going to continue to be the stalwart of strength, if you will, in terms of where we're going to continue to see activity, and where that is going to continue to push through, especially as we go into let's call it the second week of August through October, where we should be at really our peak amount of activity before we drop off for that normal seasonal slowdown in November and December. But when you look at just the cost, because the cost continues to go up, and that's not something that we're seeing adjust lower. It's, if anything, it's really getting that much worse when you consider labor and the different pieces that go into drilling. But on the completion front, again, there's that. This is what we discussed, where you were going to get that separation, where rig counts were going to continue to go up. We're going to get this really flatlining, if you will, of frac spread counts, and that was going to help really normalize that DUC count side, because we had a lot of excess, and now we have to get back to that comfort spot to provide that running room into year end. And as we've said before, and with the EIA data showed that there's 12.1 million barrels a day of production. We've been talking about an exit rate since last year of 12.2. So again, we're right in line with where we think we're going to be, with that last incremental 100,000 coming in the next, let's call it 6 to 8 weeks. But this is one of the key pieces that we talked about and we show periodically, is the steel pipe side. So you can see that we've hit another level of increase when you just look at the amount of pipe or the cost of pipe that is coming through. Now, we've been talking about how this was going to continue to run. We didn't see this slowing down. But now as we get to the other side of the housing boom, that's where we actually see this leveling off a bit. Again, leveling off, not just collapse back down to normal, but just coming, seeing some of the pare back. And it's because when you look at the pipe coming through, pipe going into the construction side isn't threaded. Pipe coming into the energy space for production, for drilling, is threaded. So when you talk to pipe guys, they're like, look, you buy the pipe, and then after you buy the pipe, then we thread it. Where in the past, they would try to thread some pipe, put it in inventory, sell it. But because things have been so tight, and after the collapse of 2020, when you had really drilling and completion going to zero and the construction boom just exploding, they had all of this pipe that they couldn't use. So now you had a separation where they're like, look, we're not going to thread pipe unless it's paid for and in the queue. But now as we get to the other side, where you have some of the supply chain on housing catching up, we talk about that in the Econ show. Now you can see some of that pipe that was destined for that level, all of a sudden getting readjusted and moved into the energy space. Not to say that we're going to go from 4,000 to 2,000. It's just the pace of increase is going to slow and actually start to come down, which will help some of the cost side, or at least keep it from getting that much worse when you're looking at some of those key equations. Now, when we look at Russian crude to India, because I think it's really important, and we talked about this significantly over the last couple of weeks. India has been the big buyer, but we have a decent amount of new capacity going into Iraq and into Saudi Arabia in order to super tankers, that is, to load up and bring that crude out. And it's going to be interesting to see where that shows up, because for us, just based on where we're getting these slowdowns, it's really going to pivot into west of Suez, and we're going to see a lot of this in both Europe and the U.S., but a decent amount, especially on the Iraqi side, in the U.S. itself. Why we continue to see a slowdown into India, especially because of price, where you look at where Russia is and how they compete into where it is, because Russian crude is cheaper than Saudi Arabian. And that's really going to continue to be the case based on the OSPs that were released. So again, that's another key component. Then next week, we're going to talk about the EIA show, but to no surprise, gasoline increased by a record going into gasoline storage in Europe increased to a record. Singapore had a small decline, but is still well above the record side. So in Europe, it's at a 2022 high. It's now above where it was in 2020. And in Singapore, it's come off the high, but it's still well above where we were in 2020, as gasoline continues to show this glut that only continues to expand on a global basis. Now we want to pivot into Taiwan and some of the issues here. So these white lines that you can see going around is shipping lanes. And you can see how important the Taiwanese Strait is for shipping and in terms of where that goes. Now you can go around, but typically the shortest distance is to go in between. Why go around if you can shave off, a day or so when you're, or two, depending on where you're coming from. So that's about 60 to 66% of shipping goes in the strait, not around it. But when you look at that nice little red spot, which is where China is looking to essentially cut off commercial traffic while they run these war games, if you will, or these drills for 72 hours, this is going to become a very impactful move. And the question is, are they going to reopen it? Now, my short answer is yes, because they need this trade just as much as anyone else. But it's something that it throws into question what could happen. So this is just a rough sketch of the shipping routes around Taiwan and China that would be impacted by the ongoing China-Taiwan standoff, possibly impacting global trade if it escalates. And to give you an idea of what is happening, so multiple Chinese vessels spotted, and they're going to be shadowed by the Taiwan Navy along the East Coast today. And this is just the imagery that has come across, but it's really important to appreciate in terms of where this is and how this is being constructed, because is this going to be a blockade? How, this is, you could just have the Chinese Navy just never going away and maintaining their footprint. And then that leads into, the U.S. runs Freedom of Navigation Acts. Are we going to continue to do that? And this is where brinkmanship becomes a concern, because as you get more assets in a location, you have more potential for a quote unquote accident or an escalation that spirals, which was something to be avoided. Now, again, there's been a breakdown in communication between China and the U.S. in response to all this, and it's just a matter of back channels remain open just to try to avoid an unnecessary situation. But again, this is going to be a key piece to watch, and we'll talk about how it progresses into next week. And all the while, there's more Chinese developers failed to pay back suppliers. So there's a lot of things that we talk about. And typically on the Econ Show, we always talk about China and we talk about the debt and what they haven't paid back. But we usually fail to recognize or talk about the supply chain and not paying suppliers. And this is that reverberating factor that we talk about, because, when you look at the backdrop and the pressure that continues to remain and spread throughout, this is a key piece, because everyone likes to say, oh, well, it's onshore debt, we don't have to worry about it. But what about the suppliers? We already know the consumer. We've talked about the consumer, the lender. What about the other lender? That is a natural lender, not so much in debt, but in equipment, in supplies. They need to get paid. Who's going to make them whole if they don't pay that back? And that's where you get this reverberating piece, because it's cascading. It's not just going to stay at the builder. It's not going to stay at the bank. There are knock-on effects that we've already seen people refusing to pay mortgages. What happens when these suppliers refuse to pay their suppliers or refuse to pay their banks because they don't have money because they haven't gotten paid for it? There's a line of credit. Most of these guys, you don't have all this cash on hand if you're buying a crane or if you're buying X amount of tons of cement or lumber or nails. I mean, you're talking about everything that reverberates through it, which is why this is far from over. But an economic pressure is only going to make the Xi and the CCP want to redirect attention, which is why we talk so much about Taiwan and the ability to use this as a rallying cry, if you will, heading into a very pivotal Congress that kicks off in October. So now taking that to the U.S. and looking at what has happened month over month. So here you can see that the non-farm payrolls had a big increase of 528,000. Now, this is a lumpy number, and July can typically be a bit shocking. And if you look at just July of 2021, you can see that June was 557, July was 689, and then August was 517. it's you have to look at, there's a lot of part-time work that comes through at this time of year, and you get a big increase in hiring for schools. So, and not to say that this makes up for some of the differences, but there was a lot of part-time work that came into this number, and there was a lot of school that came into this number. But when you look at the econ show that we just filmed and released yesterday, job cuts are increasing. So you're getting an increase in job cuts, but yet you're getting an increase in non-farm payroll, but you're getting a decline in the participation rate. So it's like, okay, well, this doesn't make much sense. And so you have to weigh all of them together because they're all going to show different things and weight things specifically. So this is picking up a significant amount of part-time work and going back to school. But then when you look at the actual household surveys, we actually had a decline, not an increase. And typically, and this is where I agree with Macrobond and Nordia, so the NFP survey is unreliable at key turning points. And that's, I think, the most important piece is because it's happened before. And it's important to look at where some of these pieces rely. And if you look at 2007, you can see that the household survey dropped well before the non-farm payrolls did. And then when you look at the noise that came in 2011 and 2012, it was something very similar. Now, obviously, 2020 was a very unique period, but look at just kind of the lag, if you will, in terms of where we are now versus before. Now, this is the largest divergence we've had in a fairly long time, but the reason why we have confidence that the non-farm payroll will follow is because of the JOLTS data, because of the Challenger data, because of the leading indicators. Because if you remember, the leading indicators from the Fed have, and the regional Fed has shown employment contracting. So you have employment contracting from the Fed data. You have employment contracting from the ISM data, from the S&P Global PMI data. You have it declining in the household survey. So again, there's one data point that's showing up, and there's multiple data points that are showing contraction and down. So again, there's a little bit of noise in here that will be, let's just say, corrected, if you will, as we go through this period, because typically July is a very funky period. And that's something that we think is going to work through the system. So now when we look at monthly employment, this is what we're talking about on education. Education, leisure, and hospitality were the largest increases in this. And if you consider, as we go into the push for year end, you have high school kids going back to school, you have college that's still there, so you need a certain amount of that replacement. And that's something that, again, we're showing as a little bit of a one-off that will then back out as we go through this period. But also confirming this is the drop in participation rate. So it went from 62.2 to 62.1. Small, but this is based off of the household survey, not the NFP. So when you look at the disconnect, you have to appreciate some of the nuances. Excuse me, when you're looking at the pieces, which is why we look at so many data sets, and really, so when you get this outlier, you can say, no, like just give it a second, it will catch up with the others. And that also feeds into the average hourly earnings, which was up 5.2% versus 4.9%. And it was revised slightly up from the prior month. So even though we're getting some of this flatlining, as we've been talking about on a lot of the other side of the equation, we've seen some of the weakness come through. So this is where we expect to see, and especially on the surveys, people are expecting their income to weaken, and that's more of the leading indicator versus what this is looking at with what has happened previously, and the surveys are looking on a forward basis. So this is a bit on a lagging side, which we think is going to, again, rectify itself. Then when you look at the equity side, so soaring home prices and large down payments on new loans push share of equity rich in Florida to 60.4% last quarter from 33.4% a year earlier. So when you look at the equity in home value, this is something that, as we showed last week, yesterday, how important real estate is for some of these areas. But it's also where we expect to see some of the biggest contraction. And now the question is going to be, how much did they lever up again when you think of the equity lines? Now, that is where we always want to look at, because equity lines was what got people in trouble when you look at 2008, and so far it is not at those levels. We've had credit in general, like credit cards, go back up to a blow through pre-COVID to the record, but net debt, and this is really the benefit of it, net debt hasn't gone up to the same way it did in 2008 because of this equity value. But then when you take that to a different level and you look at housing gains, it also amplifies the inflation risk, which is why we talk so much about sticky inflation and how there's still more upside, or at least more support on CPI when you look at the different indicators, which is why we talk so much more about stagflation versus deflation yet. But it doesn't mean that there isn't pain, because when you look at the lower income neighborhoods, they're struggling to pay loans now, and the loan payment struggle is increasing. And that's the first really creep higher that we've seen when you look at that backdrop. Now, we're not quite back to where we were pre-COVID, but as we've seen in other indices, as we've seen in other indicators, the rate of change has been accelerating, and we expect to see this close the gap very quickly when we compare Q1 versus Q2, and as we progress through Q3 and Q4. This is something that is going to become a much bigger issue. And we expect it to take out the Q4, the Q2, the pre-COVID numbers very, very quickly. So the economic slowdown is unfortunately hurting lower income families the most. Those outside of top 25% of wealthiest zip codes are seeing increased delinquency rates. And that is not surprising. The concern is it's actually happening on multiple levels. In terms of realistically, the lowest 75% of Americans are starting to struggle, which jives with what we talked about yesterday, where you're seeing over 40% of Americans that are saying they're struggling to pay everyday bills. Again, you're starting, the cracks are there, which is why we talk so much about where we're going to be in Q3 and how we believe we're already in that recession. So that's what we have for you today. If you have any questions, again, you can find us in the comment section or on Twitter. I'm always happy to answer questions or take requests. It's always, one of the requests I had today was, why were the numbers so wonky? And so I hope I answered those for anyone that was confused or wanted some clarity. And as always, we hope you have a great weekend, and thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.